My phone buzzed with 5 different dividend headlines this week. One doubled, one got trimmed despite record revenue, and one is quietly propped up by asset sales. If you are living off these payouts, that inconsistency is the whole story, not a footnote. Every one of these 5 companies has Temasek sitting on the register, which tells you nothing about whether the dividend itself is something you can actually count on. I have been tracking these corporate moves closely because a headline number and the real operational story are pulling in completely opposite directions, and I wanted to walk through exactly why. Look at the headlines hitting the local market right now. We see one dividend doubling, another getting cut even though the company brought in record-breaking revenue, and the third being quietly supported by major asset sales rather than core business performance. For any retail investor relying on this income for daily retirement expenses, seeing this kind of mixed messaging from blue-chip names is incredibly confusing. My job is to track what the broader market is saying before Iggy runs the forensic numbers. We need to figure out why these payouts are moving in such radically different ways, because the top-line headline alone is not giving you the full picture. Having a strong institutional backer like Temasek sitting on the shareholder register gives a nice sense of security, but it tells you absolutely nothing about day-to-day dividend safety. A rising payout could mean the underlying business is firing on all cylinders, or it could simply mean management is handing back cash from a one-off asset sale. On the flip side, a falling payout might signal real operational trouble, or it could just be a healthy business being compared against an unusually high gain from the previous year. We have to look past the top-line numbers to find out what is actually generating the cash. Let us start with Singapore Airlines. The headline says the total dividend for the year came in at 37 cents per share, down from 40 cents the year before. On the surface, that looks like the airline is pulling back or struggling. But if you look at the operational performance, the business did not lose altitude at all. Revenue hit a record high of 20.5 billion Singapore dollars. Passenger numbers reached a historic 42.4 million, and operating profit actually jumped by 39% year-on-year. The core business is performing exceptionally well. So why did Singapore Airlines cut the payout if the business is strong? It comes down to 2 major one-off items that distorted the net profit line. First, the prior year's earnings included a massive $1.1 billion gain from selling down their stake in Vistara, which obviously did not repeat this year. Second, they had to book $828.5 million in accounting losses from their 25% stake in Air India, which is currently undergoing a separate turnaround. When you strip both of these items out, the actual flying business had an incredibly robust year. Moving forward, the real pressure point to watch for Singapore Airlines is not the Air India accounting adjustments, it is the cost of jet fuel. Management has explicitly flagged that jet fuel costs have more than doubled since the Middle East conflict began. Right now, the airline's passenger pricing is lagging behind this rapid increase in fuel expenses. If passenger fares do not catch up quickly to offset these higher costs, that is the exact metric that will test next year's dividend. That is a much bigger structural risk than temporary non-cash accounting drags. This brings me to my first major observation for the season. We are seeing a distinct pattern where headline numbers move aggressively because of something happening outside the core operations. Singapore Airlines' core flying business is genuinely healthy. The critical question we need to sit with is whether the Air India stake will turn into a recurring drag on the dividend story or remain a one-time structural adjustment. The answer to that question will determine whether next year's headline dividend number actually means anything at all for income investors. Now let us look at Seatrium, where we see the exact opposite headline pattern. Their final dividend doubled to 3 cents a share, up from 1.5 cents last year. This came on the back of reported net profit more than doubling to $323.6 million. Revenue grew by 24.3%. Their order book stands at a very healthy $17.8 billion. And management is actively chasing over $32 billion in new contract opportunities over the next 2 years. It sounds like an absolute growth explosion. But here is the specific data point that made me stop and think. Seatrium's free cash flow, which is the actual cash left over after running the yacht and buying equipment, came in at just $19.7 million for the full year. That is an incredibly thin margin for a business of this scale. It means the total dividend payout actually runs well beyond the cash that the core operations generated. While they do have a comfortable cushion of $3.1 billion in cash and credit facilities against a net debt of $680 million, the operational cash flow itself remains tight. We must remember that an impressive order book is not the same thing as cash in hand today. For an investor holding Seatrium specifically for a steady retirement income, the headline profit expansion is less important than watching how that $17.8 billion order book executes over time. The real key to long-term dividend sustainability here is whether those contract wins successfully convert into cold, hard operational cash flow over the next couple of years. Until that happens, the dividend expansion is running ahead of the actual cash coming through the door. I was thinking about this because my neighbor in Tampines mentioned Seatrium to me recently, feeling very excited the dividend had doubled. I did not have the heart to break down the free cash flow numbers over our morning kopi. A doubling dividend and a massive order book both sound like wonderful news, but only one of them represents liquid cash today. The true test for Seatrium is not this year's celebratory announcement, it is whether that big order book can generate the cash flow required to make next year's payout feel sustainable. Next up is ST Engineering, which presents a fascinating case. On the surface, the headline looks alarming because reported net profit dropped by 34%, falling from $702.3 million down to $462.8 million. Yet at the exact same time, management raised the total dividend by 35%, taking it from 17 cents to 23 cents per share. On paper, these two directions look completely disconnected, but when you look underneath the hood, the reality is highly encouraging. That big net profit drop is explained entirely by non-cash accounting items. Management chose to take $689 million in deliberate accounting write-downs on two underperforming units, iDirect and JetTalk. This was a cleanup exercise, not an operational failure. If you strip those one-offs out, the underlying operating profit actually rose by 21% to a record $851 million. Furthermore, cash from operations remained incredibly steady at $1.7 billion, which comfortably covers the entire dividend payout, while total borrowings fell by a full $1 billion down to $4.8 billion. The total 23-cent dividend also included a 5-cent special dividend. This was funded by roughly $700 million in cash proceeds from selling off several smaller non-core units. This means the special payout was driven by balance sheet optimization rather than stretching their finances. In the exact same year that the reported bottom line took its biggest hit from accounting impairments, the business actually paid down $1 billion in debt. This proves that the headline net profit number was arguably the least useful figure in the entire financial release. This is the perfect example of a stock that would scare away retail investors who only scan the front page headlines. A 34% drop in profit sounds terrible until you realize it was a strategic choice to write off underperforming assets that the company was ready to walk away from. It is a great reminder that a deliberate balance sheet cleanup is completely different from a core business struggling to bring in money. ST Engineering's cash-generating engine is completely intact, showing that the real story is far stronger than the headline. Let us switch over to the banking sector and look at DBS. Right now, the bank is paying out a total dividend that works out to about $3.06 per share. At the stock price trading near $70, that sounds like an incredibly attractive headline yield for anyone seeking income, but we need to look closer at how that number is constructed. Roughly 60 cents of that annual payout is actually a special capital return program, consisting of quarterly distributions that are currently scheduled to run only through the end of 2027. When you separate that special capital return program from the regular distributions, the ordinary dividend yield sits closer to 3.5%, which is meaningfully below the headline figure you see quoted on financial websites. To be absolutely clear, this is not a red flag. The bank's capital position is exceptionally strong, and this program is a transparent, well-disclosed choice to return excess capital to shareholders rather than hoarding it. But it does mean a significant portion of the current high yield has a specific expiry date attached to it. We are starting to see a clear pattern across the market where banks use capital return programs to boost payouts, and DBS is leading the charge. It is a perfectly reasonable way for a well-capitalized institution to hand back funds it does not need for immediate growth. However, as income-dependent retail investors, we must ask ourselves a direct question. When 2027 arrives and this program concludes, will your retirement budget be hit hard because you expected the full payout to last forever? Or did you always budget with the understanding that part of it was strictly temporary? Singtel is showing a very similar structural pattern where a massive chunk of the payout is decoupled from core earnings. Their full-year ordinary dividend came in at 18.5 cents per share. But out of that total, approximately 5.1 cents, which represents close to 28% of the entire payout, is actually a value realization dividend. This special portion is funded entirely by 3.9 billion Singapore dollars in capital recycling proceeds, not from people paying their monthly mobile phone and broadband bills. The core dividend stands at 13.4 cents. Using capital recycling to realize value is a perfectly legitimate strategy, and Singtel's management has already announced an expanded $9 billion asset recycling program moving forward. Their interest coverage and debt profile are genuinely strong, meaning there is no immediate risk to the dividend payment itself. However, we have to recognize that an asset recycling pool is inherently finite. A company only has so many stakes and businesses it can sell down. The question for next year is how much dividend support will still come from asset sales versus the core telecom operations. Asset recycling has quietly become the primary engine driving dividend growth stories across the local exchange, and Singtel is a textbook case. While the company is being highly transparent about where the cash is coming from, it changes the fundamental question we need to ask. Instead of simply celebrating that the dividend is growing, retail investors need to evaluate how many high-quality assets are left in the pool to sell, and exactly what happens to the total payout once that recycling engine eventually runs dry. These cross-currents are exactly why timing matters so much in the Singapore market. The line separating a genuinely safe income stock from one that quietly erodes your capital while still paying it out can be decided in a single trading session once institutional money repositions itself. By the time deep balance sheet reporting trickles down to the broader public as free commentary, the optimal entry windows identified by forensic analysis have often already opened and closed. If you are acting purely on lagging public announcements, you are constantly playing catch-up against automated market pricing. This is exactly why serious retail income investors choose to get ahead of the curve. Members of Iggy's elite investors do not just receive these market reports early, they get them at the exact moment the data remains highly actionable. Zero-day access on Substack and YouTube, full Red Zone watch list, and institutional-grade cheat sheets for 9 Singapore dollars per month. It is a structured way to look at the numbers as a professional analyst rather than acting as the exit liquidity for institutional players. When we line all 5 of these major Temasek-linked companies up side by side, the conclusion is clear. We are looking at 5 completely different operational mechanisms, producing 5 very different types of dividends. Out of the group, only ST Engineering and Singapore Airlines, once you strip away the temporary accounting distortions, are paying dividends fully covered by what their core businesses generated this year. Seatrium's payout is outrunning its thin operational cash flow, while both DBS and Singtel are highly dependent on programs that carry an explicit countdown clock. Ultimately, a corporate dividend announcement should be viewed as the start of your research, never the final answer. None of these names are bad investments on their own, but their top-line yields represent completely different levels of safety and structural longevity. The single most important question you must ask every time a major dividend headline lands in your inbox is simple. What specific engine is paying for this distribution, and will that exact engine still be there to fund your retirement next year? If you want to ensure your income portfolio is built on durable cash flows rather than temporary capital programs, consider joining Iggy's Elite Investors. 0-day access on Substack and YouTube, full Red Zone watchlist, and institutional-grade cheat sheets for 9 Singapore dollars per month. The sign-up link is available directly in the description below. Angela's content summarizes publicly available market news, analyst research, and earnings data for informational purposes. Iggy provides the investing iguana's forensic ratings and analytical verdicts. Angela's role is to recap noteworthy developments across the SGX market without applying analytical filters or investment recommendations. Always read primary sources and consult a MES licensed financial advisor before making investment decisions. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.